Hey everybody, welcome to your video. I'm actually going to split it in two. The first part will be preparing journal entries, and then the second part will be the posting of the journal entries into the general ledger, and then generating a trial balance. This is Adele Foltz, your professor for Accounting 1, helping you to have dollars make sense in this world of accounting. Um, this is the problem that we are going to complete, and you should have this problem in your course. You should be able to download it and follow along. So we start with a trial balance for Lacey Company as of September 30th, 2022. And this trial balance lists all of the accounts in the chart of accounts. They are here. And it lists the balances as either debits. If it's a debit balance, it's listed in the debit column. If it's a credit balance, it's listed in the credit column. And then those balances are totaled to make sure that they agree. All of our debits equal the total of our credits. And so this is the trial balance as of September 30th, 2022. And so those ending balances as of the end of September become our beginning balances, our BB, beginning balances as of October 1st. So in the instructions, we are asked to open up the general ledger. So a general ledger is a place where all of our accounts are kept, and we get to post all of our journal entries into these accounts in order to determine what the ending balances are of the accounts. So in this case, we are asked to start out by opening the accounts in the general ledger, and also asked to add some new accounts into um, into our ledger, accounts that we are going to use. So I'm not exactly sure what those accounts are. So if you'll hang with me just a moment, I'll go look. Okay, I figured out which additional accounts we need to add. So the first thing I'm going to do is go ahead and open up the general ledger with the beginning balances. Okay, so the first account here we have is cash, and the balance of cash is 19,200. So we're going to put that in our T account. And this is a T account because it looks like a giant T. And it represents, it's kind of a shorthand of our general ledger. So we're going to put our 10-1 beginning balance. Again, if this was a trial balance as of the end of September 30th, then these are our opening balances as of the beginning of October. So cash has a debit balance, so we're going to put it here on the debit side, 19,200. Our accounts receivable has a 10-1 balance of 2,600. Our supplies, that's another current asset, and it has a balance on 10-1 of 2,100. And we also have equipment with a beginning balance of 8,000. And now we have our liabilities. They have a normal balance of a credit balance. So we have accounts payable. And because, excuse me, because that's a credit balance, we're going to put it over here on the credit side. That's the 10-1 balance. We have unearned service revenue. I'm just going to call that unearned revenue for space reasons. It is a liability. That's when we collect our customers' money in advance, and we're going to provide services later. So we owe them the services, and if we don't provide the services, we owe them the money back. So that has a credit balance. We're going to put it on the credit side. Um, and then we have our stockholders' equity accounts. Notice your trial balance is listed. First, we have our assets, and then we list our liabilities. Then we're going to list our owners' equity accounts, which are our common stock and our dividends. And then we're going to list our revenues and then our expenses. Excuse me, that's going to be common stock, dividends, and retained earnings, because that is an owner's equity account as well. Okay, so we have unearned revenue, and then common stock. So we're into our owner's equity accounts. So we have our common stock. That has a beginning balance of 15,000. We have our, let's put that 10-1. We have our retained earnings account. And that has a beginning balance of 11,000, a credit balance on 10-1. And then this month during October, we're going to pay dividends. So I'm just going to go ahead and open up that account right now. As we see on our trial balance, we do not have any balance at all, but we know that the normal balance of dividends would be a debit balance. So we're going to put our 0 in there. It has no balance. It's not on our trial balance. And then, whoops, let's move this up here. What else do we have? Okay, so we don't have any revenue or expense accounts, but in the problem that we're given, we're asked to go ahead and open up our service revenue account. It has a 0 balance as of 10-1. Its normal balance is on the credit side, so I'm going to put that on the credit side. And then we're going to have our salaries and wages expense. It has no balance as of 10-1. How do we know that? Again, we look at our trial balance, and it did not have any revenue or expense balances. So we're going to have a 0, 10-1 balance, and we're going to have utilities expense. Where did I get these from? Again, we were told in the problem to make sure that we add these accounts. Why? Because we are, oh, you know what? Notice this, look at this. I put this on the credit side. The normal balance of an expense is a debit, so I'm going to put it on the debit side. Even though it's 0, it doesn't really matter, but I still think it makes sense to put it on its normal balance side. And we have no utilities expense as of 10-1, so I'm going to put a 0 on the debit side. So once again, these accounts, these T accounts, represent all of the accounts in the general ledger, and we would have as many as we would have in our chart of accounts. Okay, so we're not going to work with those again until video number 2, when we're going to post from our general journal to our general ledger. So I'm going to pause the video at this point and get set up for our general journal. Okay, so we're back. So we have opened up our general ledger with all of our beginning balances as of October 1st. And now we're presented with some transactions here starting on October 5th. And we need to prepare our general journal entries for those. So these templates are in your course. So if you're doing them by hand first before you transfer them into Wiley Plus, then you can use the templates that are in your course. Look in your course materials folder, and you should find them there. Okay, so let's start with the first transaction. And I'm so sorry, you might from time to time hear my new puppy crying a little bit because I put her to bed just a few minutes ago. but she doesn't want to go to bed. So I think it's very likely that we hear a little bit more from her, and I might have to pause and come back to this video later. So we'll see. You might hear her. If you do, you can just kind of tune her out. I'm going to try and do that too. We'll see if that works. Okay, so on October 5th, we received 1,300 in cash from customers for accounts receivable due. Okay, so if we took a look at our trial balance above, we should have had an account up here. Here it is, accounts receivable. And it has a beginning balance. And it has a beginning balance of 2,600. And on October 5th, we have collected some of that balance from our customers. So we're going to show that we collected 1,300 from those customers. So we didn't collect it all, but it looks like we collected about half of it. Okay, so let's go down here to our general journal, and we're going to journalize this transaction. So the date on it, we're going to put is October 5th, and we collected cash from these customers. So we've received their cash and put it into our cash account. So cash is an asset. So let's see, we have assets equals liabilities plus owner's equity. And in our prior video, we talked about whether debits or credits make these things increase or decrease. We said that assets increase with a debit and decrease with a credit. We said all of our liabilities increase with a credit and decrease with a debit. And then in owner's equity, we had common stock, dividends, revenue, and expense. And we said that when common stock increases, owner's equity increases. So we're going to increase common stock with a credit because that's how we increase owner's equity. And so therefore we'll decrease common stock with a debit. For dividends, when dividends increase, that makes owner's equity go down. We make owner's equity go down with a debit, and we therefore make our dividends go up with a debit. Why? Because they make owner's equity go down. And so if we want to decrease dividends, we're going to do that with a credit. All right, our revenue. When our revenue increases, that makes owner's equity increase. So we're going to do that with a credit because that's how we make owner's equity increase. And we're going to make revenues go down with a debit. And then we have expenses. So when expenses increase, they make owner's equity decrease. So how do we make owner's equity decrease? With a debit. And so if we want to make expenses go down, we're going to do that with a credit. So I'm going to leave this up while we complete these journal entries. So on October 5th, we said we received 1,300 in cash from our customers for accounts receivable due. So we have cash. Our cash has gone up, and cash is an asset. So we're going to increase it with a debit. So we're going to start over here on the left and write in our account cash. And we want cash to go up. Again, cash is an asset. And so we're going to increase it with a debit. So we're going to put our 1,300 over here on the debit side. And now we have just increased that asset. Our accounts receivable, when we collect this cash from our customers don't owe it to us any longer. So we are going to decrease that asset, accounts receivable. How do we increase our assets? Again, how do we make assets go down? Here with a credit. So let's go ahead and credit our accounts receivable, making that asset go down. And now our journal entry balances. So we just need a journal entry description, and I'm going to say to record collection on account. Okay, that means we've collected cash on our accounts receivable. You could also indicate or write a description that says something like received collections from customers on account, something like that. I like to start mine with to record, but as long as your description adequately describes the transaction, that's all that really matters. So you can just simply repeat what you're given as the description of the transaction here. Okay, so let's look at October 10th. On October 10th, we've billed customer for services performed, 5,100. So we have performed services. Well, that sounds to me like we have earned revenue. So we're going to record that revenue, and we didn't collect from our customers. We're going to bill them. So we didn't collect cash when we provided the services, so we're going to bill them. So that sounds to me like we are actually creating a new accounts receivable, okay, a new asset where our customers owe us, or we're increasing that asset, accounts receivable. Okay, so we are going to put our date in here. We always have to put our date first. So 10/10. We have our new transaction. We need to increase our revenue. And so if we look over here in our revenue, to increase our revenue, we're going to do that with a credit. So let's credit our revenue. And our revenue is called service revenue. Yes, I am skipping a line and putting the credit down one line and leaving room for my debit, and that is 5,100. Please notice I indent both the account name, and I have also indented the credit on the right. So they both need to be on the right. Why? Debits are on the left, credits are on the right. So we're going to credit service revenue to make that revenue go up. When we make service revenue go up, that makes owner's equity go up, and that's why we use a credit. Okay, and so we now have also increased our accounts receivable. Accounts receivable is an asset, so all of our assets increase here with a debit. So let's debit our asset, accounts receivable. Making that asset increase. Okay, to record collection, oh, that wasn't collection. To record services performed on account. That means we didn't get paid at the time that we provided the service. Okay, so let's take a look at October 15th. On October 15th, we are paying our employees salaries of 1,200. So that represents an expense to the business. And so we have incurred a new expense. If we look over here, we see that expenses are increased with a debit. Why is that? Because expenses decrease owner's equity, and we decrease owner's equity with a debit. So when we increase expenses, we want to do that with a debit. So the first thing we're going to do is put our date here on 10/15, and we are increasing our salaries expense. So we're going to do that with a debit. So we're going to debit that for 1,200. Once again, putting my debits all the way to the left, both the account name and the amount. Okay, so we paid our employees' salaries, and so the other account that is affected is our cash, and our cash has decreased as a result of this transaction because we paid our employees. So let's go over to our accounting equation, and all assets decrease with a credit. So let's go ahead and decrease our asset cash by crediting it and making it go down. To record payment of employee salaries. Once again, I like to put to record at the beginning of every journal entry. That's so for future chapters, I can just write to record ... and I can speak it and not have to take the time to write it all out. You, however, as accounting students, need to write out your descriptions whenever you're preparing journal entries. Unless in Wiley Plus, they don't provide the space for you to do that. So I want you to practice doing it. And so I just start mine all with to record so that in the future I can just stop there. But you could also say for this description that you paid employee salaries. That would be fine. You don't have to use to record. Okay, on 1017, let's move to that transaction. Also, let's just take a moment to review the 3 rules that I gave you of debits and credits. One is I said that debits are always on the left and credits are always on the right. And you can see when I prepared my journal entries, I put all of my debits, both the account name and the balances on the left, and I put all of my credits, both the account names and the amounts, on the right. I also did that over here when I opened up my general ledger accounts. If the balance was a debit balance, I put it on the left side of the T account. And if the balance was a credit balance, I put it on the right side. Okay, so that was rule 1. Debits on the left, credits on the right. The second rule we said was that you have to have at least one of each. So accounting uses double entry. That means that you have to have at least 2 different accounts affected. So as long as you have at least one debit and at least one credit, you have followed that rule. Doesn't matter if you have 10 debits and only 1 credit. That's fine as long as it's at least one of each. And then our third rule is that the total of our debits must equal the total of our credits. Well, so far we've had only one of each, and they have equaled. So in this problem, I don't think we have any more than for each one of these transactions, 1 debit and 1 credit. But just remember, you have to have in each journal entry, all of your debits equal the total of all of your credits, okay, no matter how many you have. All right, so let's take a look at 1017. All right, so in 1017, it looks like we are performing services this time in exchange for cash. So we're getting paid at the time that we provided the services. So we provide the services. That sounds like a revenue to me. It sounds like we've earned it. So we're going to get to record it. We've earned it because we provided the services. And then we're going to get cash in exchange. So cash is an asset, and that sounds like that's increasing. We got paid. So let's move this sheet up here. Hang on, let me find the right spot to do that. If I do it in the wrong spot, it moves other things. Let's see if it's over here. Hang on. There we go. All right, so on 1017, let's make it a little bigger again. Okay, so on 1017, we're performing services in exchange for cash. So the first thing we're going to do, as we always do, is write our date. And we received cash. So cash is an asset, and we want it to increase. How do we make assets increase? We debit them according to our accounting equation. So let's debit cash. Whoops. Let's debit cash and make it increase. Again, all assets behave exactly the same way. So when we debit any asset, doesn't matter which one it is, it's going to make it increase. If we credit it, it will make it go down. So we have now made our asset cash increase with a debit, and we have provided services. So services are revenue. We come over here into our accounting equation, and we see here are our, where are revenue? Oh, where is it? Let's see. It's a little hard to see. Let me make it bigger. Well, hopefully you wrote it a little clearer on your paper, but it's here. We have our revenue increasing with a credit. So we have service revenue. Again, we're going to indent the account name on the right, and then we're going to credit the amount on the right side as well. And we need a description, and I'm going to say to record services performed for cash. Okay, don't worry, don't get fancy, just repeat what you see in the description. Okay, so let's move on to the 20th. On the 20th, we paid $1,900 to creditors for accounts payable due. So if we look up here at our trial balance, we will see that we had a balance, accounts payable, and we owed $4,800. So we're going to make a partial payment on that. We're going to pay $1,900. So after we make the payment, we will no longer owe $4,800. We're going to owe $4,800 less $1,900. So that liability is going to decrease. It's going to go down. So, and we're going to use our cash. So our cash is also going to go down. So cash is an asset, and we're going to make it go down with a credit. Let's put our date in here, 10/20. Now, again, I'm going to skip a line so that my credits can appear first. It's not technically wrong if you write your credits before your debits, but most accountants try to put their debits first. It really doesn't make much of a difference, except that in Wiley Plus, you want to get practiced at putting your debits first because it's going to be self-graded. And if you list your credits first, it's going to mark it wrong because that's where it's going to look for its debits, and you put the credits there. So just save yourself the trouble and make sure you always write your debits first. So I'm going to skip a line and put my credit to cash here. Cash is an asset. Crediting it makes it go down. And I am going to debit accounts payable, and let's take a look at what that does to accounts payable. We said that after we make this payment, we don't owe it any longer, so therefore our liability decreases. So let's take a look here in our liabilities and our accounting equation. We said liabilities increase with a credit and decrease with a debit. So did we do the right thing by debiting our liabilities and making it go down when we made the payment? We sure did. Okay, and we need a description. So to record, I'm going to keep it simple and say to record payment on account. Is it okay if you repeat what was given to you not even say to record? You could just say paid $1,900 to creditors for accounts payable due. Is that okay? It sure is. Okay, on 10/29, we paid a $300 cash dividend. So, let's see here. That moved. I didn't want to do that. Let's see if it'll move it back. It didn't. So these things look a little off. Let's see. Okay, there we go. That looks right. Okay, so on the 29th, we're paying a $300 cash dividend. Remember, when we pay a dividend, that's when we are giving cash back to our owners. So when they make an investment in the company, we increase the cash if they've given us cash or some other asset, and we increase common stock. When we are making a profit, sometimes we pay some of those profits back to our owners in the form of a dividend. And so that makes owners' equity decrease. So because we paid a cash dividend, our cash, our asset cash is going to go down and our dividends are going to increase. So let's take a look at how we make dividends increase. Dividends are part of owners' equity and they make owners' equity decrease. So we do that with a debit. So let's put our date here, 10/29, and debit our dividends account for 300. Debiting dividends makes dividends increase, which makes owners' equity decrease. And that's exactly what we want to do because we have now paid our profits out to our customers. So, or not our customers, to our owners. So we want owners' equity to decrease, and that's what we've just done. And then we used our cash to make this payment. So we've decreased our asset cash. And as we see up here, to decrease our assets, we do that with a credit. So let's credit cash for 300 to record payment of dividends. Okay, so we have only one more transaction left, and that occurs on October 31st. We paid utilities of $400, and so that is an expense of our business, and so we need to record that journal entry showing that our expenses increased. How do we increase an expense? Over here, we increase our expenses with a debit. Why? Because debits make owner's equity increase. When we increase expenses, owner's equity goes down. So let's increase our expenses with our debit. So we have utilities expense. And of course, we never forget to put our date on our journal entry. So we are going to debit utilities expense 400, and we paid that bill. So we're going to credit our cash. Cash is an asset. Crediting it makes it go down. To record payment of, let me move this up here, October utilities. Okay, so we've completed all of our journal entries. Of course, in a real business, we would probably have many, many, many more transactions than this, but what we're doing is the same thing for each transaction. I don't care if we had, let's see, we had 1, 2, 3, 4, 5, 6, 7 transactions. I don't care if we had 7 transactions, 700 transactions, 7,000 transactions. This month, we're doing the same thing. We are taking a look at our accounting equation and seeing how that transaction affected our accounting equation, and then we're making that happen with debits and credits. So first, we talk about it in English, and we say, what happened to the accounting equation? Did assets go up or down? And then we translate that into accounting language by using debits and credits. Always following the 3 rules of debits and credits, and until we have recorded the journal entry for every transaction. Also, please take a note that all of your transactions here were in chronological order. So we generally find in our general journal that our transactions are recorded in date order. Okay, so I'm going to conclude this video. That's probably enough for you to watch in one sitting. And then part 2 will be to post our general journal entries into our general ledger. So you have to know the difference um, between a general journal and a general ledger. And our general journal is where we write all of our journal entries. And that really is the story of what happened to our accounts in all of these transactions. And then what we're going to do is post them into our general ledger, and we will have, as we did here, we're going to have uh, an account for every account in our chart of accounts, and we are going to post these transactions so that we can find out what our ending balances are in each of our accounts, so we can generate a trial balance and make sure all of our debits equal all of our credits. Okay, so thanks for watching, and stay tuned for part 2.